Trade Like Warren Buffett by James Altucher is an eye-opening investment book that goes beyond the usual story about Warren Buffett, the legendary value investor. Altucher reveals a lesser-known side of Buffett's strategies, showing how diverse and dynamic the Oracle of Omaha really is. Buffett didn't start off as a buy-and-hold investor. In this video, we will summarize Buffett's earlier investment playbook, which includes market timing and trading in and out of assets. Isn't it something that we really never knew of Buffett? James Altucher, the author, published the book in 2005. Altucher himself is a successful entrepreneur, angel investor, chess master, and prolific writer, challenges common perceptions by breaking down Buffett's multidimensional approach to trading and investing. This book is your go-to resource to boost your portfolio's performance and better understand Warren Buffett's diverse investment style. But before we dive into the 3 key takeaways of the book, remember to hit the like button, subscribe for more enriching content, and let's embark on this transformative journey together. Warren Buffett, From Zero Millions. In the first chapter of the book, Altucher talks about the early years of Buffett's investing career. This period was when Buffett built his initial wealth from zero to his first 20 through 25 million. Buffett started his own business out of his parents' living room in Omaha after he failed to get a job with his hero, Benjamin Graham. Buffett started by forming partnerships with investors and taking a share of the returns, a model very similar to our modern hedge funds. It is very beneficial for investors to study and learn from Buffett's early days investing methods, whereas Buffett's current investing style at Berkshire Hathaway is tailored to manage a diversified portfolio of billions of dollars, which is probably not something an average investor can use or relate to. Key takeaway 1. Value investing. In the earlier days of Warren Buffett's investment journey, he invested in micro-cap companies, these cigar butt companies that were trading less than their liquidation value. These happen when companies are going through serious financial crisis. Buffett would buy up significant shares of these companies if he sees substantial intrinsic value in them, so he can gain control of such companies and be able to influence the company's future decisions as a big or majority shareholder. Even after the earlier days, Buffett has always looked for undervalued companies due to temporary crisis. Companies like Washington Post and American Express both went through periods of crisis, but their brands had such intrinsic value. Buffett understood this principle and was able to capture big returns through these investments. Altucher delves into the importance of value investing, drawing inspiration from investment experts Benjamin Graham and David Dodd. According to them, the market value of a company should align with its intrinsic value, and if it falls below, reevaluation or potential liquidation may be necessary. To exemplify this point, Altucher references a historical case from Warren Buffett's portfolio, the Sanborn map. As we mentioned, Buffett liked to find undervalued companies that have hidden potential. Buffett's success is attributed to actively engaged, negotiated, and took control of the situation. Instead of spreading investments widely, Buffett showcased how a departure from traditional diversification might unlock shareholder value. Altucher further emphasizes Buffett's unwavering commitment to a guaranteed margin of safety in all investments, extending beyond stocks to various financial instruments. The key takeaway is Buffett's consistent pursuit of additional layers of safety, questioning initial assumptions and potential risks associated with each investment. How could one apply the cigar butt companies to one's investment philosophy? In a bear market, we often see companies that are mispriced and are ridiculously cheap. Of course, one would need to do considerable research before putting money into cigar butt companies. But buying into brands that have intrinsic value during a bear market can oftentimes prove to be a very wise investment. Key takeaway 2. Buffett's ownership philosophy. Be an owner. Take ownership. In this part, James Altucher takes us on a journey into Warren Buffett's fascinating perspective on owning stocks. It's not just about trading, it's about seeing yourself as an owner. Altucher walks us through Buffett's unique criteria for evaluating stocks, and he does it with a charming analogy: a lemonade stand. Imagine you're evaluating a business like you would a lemonade stand. Altucher shares that Buffett looks at stocks based on their potential to bring returns worthy of your hard-earned cash. Like deciding whether to invest in that lemonade stand, Buffett considers factors like expecting positive returns on your investment and comparing it to other opportunities. But here's where it gets interesting. Altucher brings up the challenge of valuing complex businesses and the unpredictable nature of future cash flows. Buffett doesn't dive into complicated valuation models or technical analysis. Altucher underlines the difficulty of predicting earnings for intricate businesses and how Buffett steers clear of such complexities. Then Altucher switches gears to Buffett's reactions during market events. Using the salad oil scandal with American Express as an example, it showcases how Buffett assesses situations, considering management responses, the impact on the core business, and how consumers and merchants perceive it. It's a testament to Buffett's knack for spotting opportunities in distressed yet fundamentally strong businesses. Altucher also sheds light on Buffett's struggles during the dot-com era, facing challenges in valuing tech companies due to his lack of expertise in the field. He contrasts Buffett's approach with the public's speculative venture capitalist mindset. As an average investor, it's hard to own a majority stake in a company, but what we can do is put in the time to do diligent research and become an actual owner that cares about what really happens to a company. The more engaging we are, the more we are to know the overall health of a company. Key takeaway 3. Convert assets into other assets with higher value. This is a core element of Buffett's workout strategy, where you buy an asset convertible into others with higher value. Altucher provides examples, highlighting the ongoing relevance of this strategy. Relative value arbitrage is about buying an asset convertible into others with greater value. Altucher emphasizes its importance in Buffett's workout approach, focusing on exploiting valuation disparities. He illustrates this with the Palm Computing and 3Com case, showing how rapid share surges created a valuation mismatch. Altucher draws parallels with a historical example involving Benjamin Graham and the Cunningham Exploration Company, proving the longevity of such arbitrage opportunities. Buffett's first arbitrage experience at Graham-Newman involves Rockwood and Company, a chocolate maker with a cocoa surplus. This showcases Buffett's early knack for creative arbitrage strategies. As for an average investor like us, we can capitalize on price discrepancies, whether due to a proposed acquisition or there is a big disconnect between the trading price and the actual value of the asset. I found this book fascinating as it looks into the earlier days of Warren Buffett's investing style. As the saying goes, do not put all your eggs in one basket. It does have merits in mitigating risk. Whatever you do in life, have a cushion of safety. Take only calculated risks. We hope this Trade Like Warren Buffett overview is helpful and informative. Remember to focus on what works for you. Be it fundamental or technical, stay patient, and to make decisions based on your own research and logic, rather than emotions. And don't forget to like and subscribe. Thank you for watching, and we hope you have success in your investment journey.